EXR is trading towards its 52-week low, but is it a buy now? Can we lock in a really low price for EXR, get a very nice forward yield, and see that yield on cost increase year on year, soon to be double digits? Now, we're going to take a look at the historical performance of Extra Space Storage. We're going to take a look into their income statement, their revenue growth year on year, their bottom line net income. We're going to also take a look at their total cash versus total debt, which will lead us nicely into the dividend safety, some very important financial metrics for EXR REIT. And then, as always, we're going to run it through our stock valuation model, getting to our intrinsic value and getting to our final acceptable buy price given our margin of safety. Now, year to date, it is down 10%, which does significantly lag the S&P 500, which is up over 16% year to date. It is, as I mentioned, there at the 52-week low and does currently offer a yield of 3.14%. Now, shareholders who have been holding the company over the last 10 years would see a very nice plus 214% share price appreciation, which doesn't even include those nice dividends reinvested. So, on historical basis, it does look very good. Now, in terms of their income statements and their revenues, what we like to see on the top line is around 5 to 10% year-on-year growth. December 2018, they reported 1.2 billion on the top line. 5 years later, 1.97 billion. So very nice growth. And what I like to see is that consistent increase year on year, which is always very positive. Now we want to see if that's essentially mirrored at the bottom line, their net income. Well, 2018, 415 million reported on the bottom line. 22 December, 861 million. So more than doubled over the period. We can also see the consistent increases year on year. Some years where the increases weren't as large. However, for example, 2020 to 2021, a very sharp increase. Nonetheless, what I do like to see is the fact that over at least a 5-year period, it has increased. So that is positive in its own right. We then move on to the balance sheet of Extra Space Storage. And what I like to look at is their cash versus their total debt. So their cash on the balance sheet around 58 million in 2018, and we can see in their latest quarterly report it has dropped slightly around 12% at 51 million. So let's see how that essentially compares to their total debt. So we can see here their total debt 4.8 billion December 2018, and it has nearly doubled to around 7.7 billion in their latest quarterly report. And what will be interesting to see is how this affects their dividend safety and some very important financial metrics. Straight off the bat, 66 for the dividend safety score, making it safe, on the lower end of safe. So let's understand why. Market cap 27.2 billion, making it a large cap company. Now, some key metrics, we'll run through all of them, but specifically on this page, we'll look at the ones for those who believe we're heading into a recession. Straight off the bat, they cut their dividend during the 07-09 recession. Their sales were essentially flat, which interestingly is above the average growth during the last recession, 07-09, which was in fact negative. However, the actual recession return was worse off than the S&P 500, which was negative 55. EXR was negative 66. So a lot to digest if you believe we are heading into a recession. Now, they have been increasing their dividends over the last 13 years. Latest increase, 8% in February 2023. Last 5 years, 14% on average. Last 10 years, 22%. So very strong dividend CAGRs here, in my opinion. Compounded annual growth rate. Double digits over the long haul. Very nice to see, especially when we looked at that share price appreciation over the last 10 years. So very positive. One thing to note for those that are new, we always aim to get at least 4% increase in our share, in our dividends, in our other income producing assets, or even our salaries, as the US inflation rate over the last 40 years was 4%. So if you're getting less, you are taking a pay cut and losing purchasing power. Now, dividend yield theory states that a company is undervalued when the current yield sits above the 5-year average. And look at this, what we have, a massive sign of undervaluation. As always, we never look at any model in isolation, and we'll draw our conclusions at the end. What we can see here is this is essentially, over the last 5 years, the highest yield that extra storage has ever offered at just over 5%. And we can see here the forward P to AFFO ratio is below the 5-year average, another sign of undervaluation, and probably the lowest it's been over the last 5 years. We can see here the sector P to AFFO is essentially in line with Extra Space's P to AFFO. As I mentioned, it is right there bang on at the 52-week low. However, that's purely for information purposes and doesn't signal undervaluation. Likewise, it wouldn't signal overvaluation if it was at the 52-week high. Now, regular viewers will know that we look at the free cash flow payout as the earnings is susceptible to manipulation by management through accounting. However, for REITs, as mentioned here, it's better to look at the adjusted funds from operations payout. Now, typically what we like to see is below 90% for REITs, but what we can see here, for the large part, it has been in fact below 90%. Their latest was 67% in 2022. It looks like we don't have data for these years, but from 2013 and 2016, it was below that. 2022, again, below 67%, with 2023 expected at 74%. So well below the 90% threshold. Very positive to see, especially given their increase that we saw, 8% in February 23. So very positive in my opinion. And then likewise, we look at the adjusted funds from operations. $2.12 in 2013, $8.90 in 2022. Very strong growth over the last 10 years. And what we can see here is it's expected in 2023 to drop very slightly from 2022 to $8.75. But again, the increase over the period, growing over 4 times over the last 10 years, is very strong for this company. As I mentioned, 5 to 10% is what we like to see for REITs over the long haul. And what we can in fact see here, 2013 to 2016, double digits well above 20%. And even from 2017 onwards, it's still very, very strong. So for me, this is great. It may not be super consistent in the increases, but that doesn't matter when they are at least achieving the minimum 5 to 10% consistently. So this is a very, very positive sign. 530 million reported in sales in 2013, just shy of 2 billion in 2022, almost 4 times increase over the last 10 years, and very, very consistent. So this is very, very positive so far. I'm liking a lot what I am seeing. Now, shares outstanding. For those that watch this again regularly, we do love it when companies do share buybacks, returning excess cash to our shareholders. But what's very typical for REITs is the complete opposite, where they issue shares to fund property acquisitions. And the reason for this is that they retain very little of their internally generated cash flows, as they do pay out the majority in dividends. But what I would say about this graph is they don't seem to be issuing a ton of equity over the last 10 years, which is very positive, as it's typical with the REITs to see this graph go up very, very sharply. So for me, this is a positive. ROIC, one of my 7 golden dividend metrics. Do go check out the pinned YouTube video if you haven't to see the other 6. Above 10% is what I like to see, as it means management are able to effectively allocate their capital. But with REITs, interestingly, what we see is around 3 to 5%. So the fact that we're seeing here much higher gives me a lot of faith in Extra Storage management. Not only is it higher than the 3 to 5%, but what we can see is consistently increasing over the last 10 years, with 9% over the last 2 years. So for me, very, very positive. Operating margins, again, very nice, very high, very consistent, between 40 to 55%. So again, another positive for this business. Now, what we did see was the fact that their cash balance was very small in comparison to that ever-growing debt balance. So in terms of the net debt to earnings before interest, tax, depreciation, amortization calculation, we'd like to look at below 5.5, as this is essentially the threshold for when we are analysing our stocks. What this means, 2022, it would take the company 5.47 years to pay off their debt net of cash on hand. And we can actually see, for the large part, it has been significantly higher, and this does, in my opinion, attribute to this slightly lower than we would have liked dividend safety score of 66, although it is still safe. On the positive, in 2023, it is expected to come down to 4.65, which is good to see. And here, for information purposes only, 65% of the company's financing is from debt as opposed to equity. Now, as always, if you are enjoying the content, value is being provided, do hit that like button. It really does help the channel. Do subscribe for more content directly on your doorstep. And if you want to have your own model to run through your own company with your own estimates and judgments, do click the pinned description below and grab a copy. Now, earnings per share for extra storage, 635. Growth rate per analyst estimates and yield on AAA corporate bonds. We've all inputted these numbers. One thing to note, however, is that for REITs, we do not use Graham's valuation as it is not appropriate. However, just showing you what we would normally do with companies that aren't REITs, we would then get our intrinsic value and take it from there. But this will not take up part of our intrinsic value calculations, purely there for information purposes only. Now, the first model we are using, the REITs multiple valuation model. Companies in a similar sector and size, Public Storage, Prologis, CubeSmart and Stag. If you want to check out a video on Stag and also PSA, both have been uploaded to the channel. Do go check those out. Stock price, P to AFFO multiple, average multiple multiplied by the current price over the P to AFFO gives a REITs multiple valuation of EXR of $169. Now, when we take a look at that, it is higher than the current trading price and well within that 52-week price range, showing some nice signs of undervaluation. Now we move on to the dividend discount model. We can see the average growth rate quite strong over the last 5 years at 14.62%. Forward looking, I've gone for around 5%. You could argue much higher and probably would be justified. However, I'm trying to be a bit more conservative in my estimations. As always, if you want to run your own figures through, do go pick up a copy and play and run your own estimates and judgments through. This gives us a DDM price of $210. Right there at the 52-week high, showing some nice signs of upside and growth to the current trading price. We then move on to the final model, the discounted cash flow model, where we can see the growth rate year on year at 322%. We have stone with 2023 at roughly 2020's price as per analyst estimations, included with their growth rate. We then use our discount rate to get the present value of these future free cash flows and terminal value. Add the cash, subtract total debt and get to our equity value. Once we divide that by the shares outstanding, we get a DCF price of just under $134, roughly there on the current trading price. So then this moves us on to the intrinsic value. As always, do hit that like button and do subscribe to join the community. So the intrinsic value is essentially the average of the three models we have just run through, coming in at around $171. Now we have the current price at around $130. Typically, strong financial metrics, wide moat, good forward-looking data, we would go with a margin of safety of 10%. Now, in my personal opinion, you can justify 20% for this company, which would mean an acceptable buy price at the current trading price. Therefore, if you were looking for a margin of safety of 20%, your acceptable buy price would be up to $137, which is still within the buy price today. Wall Street forecast over the next 12 months for the price to rise to around $165, showing some nice upside to the current trading price. As always, let me know your thoughts in the comments. Are you a shareholder? Are you looking to buy or even looking to sell EXR? Do let me know, even if you are on the sidelines. As always, like, subscribe, have a great day and catch you on the next episode. Take care.